Welcome to another episode of the Capital Spotlight. I'm your host, Rob Beardsley. Today we have Peter Auerbach with Auerbach Funds. Welcome to the show.
Thanks for having me.
Yeah, no, good to have you on, Peter. Looking forward to diving in. So start off with just a background on yourself as well as your company.
Sure. So Auerbach Funds has been in business for 5 years. We operate 2 closed private equity funds. We have about 250 million of asset value at acquisition in our portfolio. We have 5 on staff. We give monthly distributions. We're about to give our 46th consecutive monthly distribution on Fund 1, our 14th or 13th on Fund 2. We invest only in the United States in 23 separate transactions. 2 of those are large single-family home portfolios, but in essence, 23 commercial assets if you include those portfolios. We look to provide capital to sponsors around the country, taking typically anywhere between 70 to 95%, typically between 90 and 95. Our focus is value add and opportunistic investments. Our niche has been one of the few capital providers that will do smaller deals. We feel that it gives us a lot of buying strength. We look to generate, after the sponsors promote, about an 18 for the fund in terms of IRR. And we're smart money, and we like to make it clear that we want to be involved from day one if possible. We're simply not going to be passive, but we have been told that we are accretive investors. For instance, we can help get debt. We can talk with the brokers. We don't own that much retail. It looks big on a square footage basis, but we're primarily multifamily. But on more commercial assets, we can use our existing relationships with lenders and tenants to focus more. We could use our expertise, our contractor relationships on the multifamily end. So we find that we're somewhat of a value add to our sponsors, and our investor base, it really started as friends and family, and it remains so. We're very fortunate. We're raising our 3rd fund, and we tripled what we thought we'd get from friends and family. Our first close is about 11 days from now, and that was very flattering, all existing investors. And now we're sort of branching out to talk to RAAs, larger family offices, and that's going to roll out in 2 months. Just like with everything, you have the big website overhaul and all the pretty decks and PPMs. But we think we have a good story, and we think that we focus a lot on wealth preservation as well as strong returns. I don't think those have to be mutually exclusive.
Great. So you mentioned early on that you're investing out of 2 funds. Is that sequential, or are there 2 different strategies that you're investing out of?
No, it is all one strategy. That's good to clarify here. And just excuse me a second, I lost the Zoom. Okay, there we go. Got it back. So a lot of monitors. It is the same strategy every time. We don't look to reinvent the wheel. Fund 1 was deployed. Fund 2 was jumping the gun. We didn't really market it very much. It was I think 95% or 94% existing investors that jumped in. We closed it early. Fund 3 is our real next fund, and the same exact strategy. Value add, opportunistic. We look at markets, and we think markets are relevant, but we try to be market agnostic to a degree. Once you get out of that big core section, difficult to buy in the core markets. And as we've seen in New York, terrible situation. No
doesn't always pay.
Right, but if everybody overpaid, that situation is going to be exacerbated.
Right. So another thing you mentioned was being flexible and going to a smaller size, check size, deal size. So give us an example so we have some numbers to go on as far as what that means.
Sure. Well, we bought an asset in Huntsville, Alabama, and we had bought that, give or take, 2 years ago, a little less. And because of the small check size, we were able to secure it because of the strength of the fund, the strength of the equity. Typically, on these smaller checks people are syndicating, we sell to people that are syndicating a lot, and they typically pay higher prices than others would. They're very fee oriented, and they need to pay a higher price because when the seller asks, where is your equity coming from? And they say, well, we're syndicating it. That creates a situation of, I wouldn't say mistrust, but less of a hit rate. So in anything, if you're going to have less of a hit rate, if I'm selling the property, I want to make sure that I'm getting top dollar. You're giving that person a chance. So we've had a lot of strength there. So that deal was, I believe, a $4 million equity check, or 4.2 in total. We had a very good sponsor. They put in 10%, and we've done very well there. I think a lot of it was a residue of having the buying power to jump on these smaller deals. Don't get me wrong, we've done some larger, at least larger for us, $9 million equity checks. But we find that the smaller deals have less competition and less intelligent competition. Not that these people are not intelligent, but less efficient competition.
Absolutely. You mentioned you hit on a couple other points about why you guys are unique. Talk a bit more about the value add that you bring to the table outside of just, being a capital provider.
So, with the smaller guys, we have two instances where we've basically put people in business. We are able to use our technical ability and our thought process. Sometimes you can buy something really cheap. Let's say you have a great deal of down units or a lot of distress, and it's not looked at by all angles. I think that sometimes people get somewhat myopic. So what we're able to do through our experience is say, listen, you're dreaming if you're going to get these units up for $12,000 a pop. This is going to be more of 20. Now this deal may work at 20, but let's take realism and look at it. By the way, we know somebody here that's going to come, take a look at it, and get the honest numbers. I'll come down myself. Someone on my team will go down themselves that's done this. I mean, in my career, I've done tens of thousands of these. So I believe that experience and strength leads to creativity. Very difficult to be creative if you have not had experiences, because you could learn something you did from one case, something you did from another, and you have the illusion of creativity that you look more creative than you are. You've simply seen these things before, and you have more arrows in your quiver by which to be creative.
So another thing you mentioned was being value added on the debt side. Have you or your fund been involved with getting involved on the co-signing guarantees, bad boy carve outs?
We typically do not. There is only one deal out of our entire portfolio where we have some exposure. Let's put bad boys aside and we'll get into that. And I think this will be instructive for your listeners to see how an equity shop will do things. We've signed one guarantee and we charged, this was where we were only 60% of the stack and the other 40% was syndicated. And it was not an aggressive loan whatsoever. So we were happy to sign for a portion of it that we took a calculation, but we also charged for those services to the other 40% of syndicated investors. It was a unique deal. But the typical answer is no. We don't like to do that, going back to wealth preservation. With regards to bad boy carve-outs, we have signed on them twice. And in both cases, we control the books, we control the bank accounts, where it would be on us. That was the requirement of the lender because we weren't passive. To bring it out for unsophisticated investors, or what you're doing when you sign on the bad boy carve-outs is you're basically saying there's not going to be fraud. And fraud is not as prevalent in the business as it was 40 years ago when I was, a fetus. Banks have lock boxes. You usually have your bank in custody at the lender. Very difficult to do that, especially in commercial. I mean, that all goes. So there's very little money changing hands. There's or very few transactions. There's a lot of money, very few transactions. So the bad boy carve-outs really have to go on the person that is responsible every day for the operations of the property. So we typically don't sign on it. That said, what is common, not just for us, is in these legal documents, we have major decisions, and a lot of major decisions. That's sort of one of the rules that you have for putting someone in business. If you're going to be their first institutional fund, you have to do a lot of hand-holding. So we have a great deal of major decisions. As such, if a lawyer gets involved and says, well, in theory, you have major decisions, you could decide to do this, which could trigger a bad boy. So while we will not sign on the bad boy guarantees, we will indemnify if a decision that we made triggered a bad boy. And that's strong enough for us, because what's on a piece of paper and reality are sometimes separated. In reality, there is no major decision that I would make that would cause fraud. We're deciding on whether to accept a lease from a certain tenant or a leasing guidelines. There is nothing in there. So we're happy to sign on it. We only sign on things that we can control, but we would never sign a bad boy carve out on something that we don't control. It just puts our investors at unnecessary risk.
Makes sense. So going to your return requirements, you mentioned 18% as that number that you're solving for. How has that number changed over time, or over the life of cycles, or depending on the strategy or the market?
Good question. We try to be cycle agnostic. So, the cycle refers, and it goes towards a larger point, but the cycle refers to this ebb and flow of pricing. And you see that a lot in more core assets and assets that really fluctuate with interest rates. I mean, that's really what it comes down to in terms of where your cap rates are. Interest rates go up, clearly cap rates have to go up as well in order for people to get their spread. What we do is a little different. We call it the apples and oranges model. If an orange sells for $1 and an apple trades for 50 cents, and we can put 20 cents into that apple. So now your apple is worth 70 cents, but you've sort of, by whatever alchemy, your value add, you've turned it into $1, or turned it into an orange, which is worth $1. And now that orange, the orange market goes down 10% to 90 cents. You have still, through alchemy, otherwise known as value add, really have a basis in that orange at 70 cents. So you can be market agnostic. Clearly, our returns will go up if the orange market goes up. What we see in more of the larger deals in the core market is that oranges are $1, apples are 80 cents. I'm going to put 19 cents into the apple and now own an orange at 99 because I am making the bet that oranges are going to go up to $1.20. That's a bad bet. And that's when people say this stage in the cycle, because they're gambling. I hate to use such a strong word, but they are. I look at the NAREIT index. It's been destroyed because that was all about cycle, cycle, cycle. We're all about what makes common sense. So to put it a point further, how do we protect ourselves from the quote cycle? The cycle, more or less, refers to cap rates. What's someone, or multiples? I'm not sure who's listening. And let's say I tell you that your property is now worth 25% less, and you're only making 3% on that property. Well, you have a problem. You have debt coming due, etc. But if you take a different approach and you look at deals and say, what, after I'm done with my value add initiatives, what am I going to cash flow to investors? Well, then when someone tells you it's worth less for COVID or whatever the reason may be, as long as you're cash flowing, which is the purpose of investing in these things in the first place, you're going to be okay. What you see now, and it's a perfect storm in areas like New York, there's no cash flow, there's no nothing, but there was no buffer there. So we try to stabilize into double-digit returns. We may not buy it at those, but that is the game plan to use existing market rents. And if we're getting existing market rents to stabilize owning something that is solid in a decent market at double-digit returns, you're doing pretty well. We have not missed a distribution in either funds throughout the entire pandemic. First week of the month, distributions. And while we've had some luck and some fortune, our retail centers were a lot of essential. And that was not by design. I'd love to take credit, but it's not. We had that strategy where you had enough assets cash flowing that even those that suffered, we were able to continue our returns. No keys even spoken of given back. And now we're in a position that we could sell a bunch of those assets and capitalize on the lower interest rates and the flood of money that's left commercial and gone into multifamily.
Interesting. I think you brought up a good point about the market rental rates, because a lot of people associate value add with the idea of taking an existing stabilized asset and pushing it to the next level through interior renovations, taking it to granite, stainless steel appliances. And to me, I think we align in that way because that's a completely different business model where you and I are more focused on buy it, fix it, sell it, or at least take something that is underperforming the market and bring it to market rather than making assumptions that we can push it beyond where the market is.
I think that's a very good point. I think that brings up, we'll tackle it in two. One, we'll talk about on an individual basis, and two, within the asset, and two, the sale of said asset. So on an individual basis, there's something to be said for replacing countertops and doing a heavy lift. That can sometimes work. It works a lot better if you buy it at a cheap basis. It all depends on your basis, right? If you could buy it cheap and no one's pushed rents at all. Where you get into trouble is when you believe you're going to set rents that have not yet occurred within the market. So it's a simple exercise. And I recommend that investors that are going on crowdfunding, et cetera, doing it is look at the rents that are being pro forma and look around to see what rents are being achieved in that current market. If you see that you're going to get an extra $200 a month, I'm sorry, my chair's uncomfortable. If you're going to get an extra $200 a month by doing $3,000 worth of work, clearly that's a good return on your capital. But if you're currently getting $1,300 and the best guy in the market's getting $1,400 and you're performing $1,500 and trying to set a market, you might be right. And that could happen. Unlikely that it's not a good wealth preservation strategy. So that's number one. Number two is you see a lot of financial models that plug in a cap rate at the end and assume that, well, cap rates are 6% now and I'm going to sell it in 3 years at a 6 cap. Well, baked in to that 6% cap rate now is the upside. And people don't realize that, ironically, a stabilized asset can very well trade at a higher cap rate because the people chasing that asset class want growth. So that's number one. That does not apply, however, if you could turn a B asset into an A asset. A assets typically do trade at lower cap rates because they're easy, foreign capital wants them. But if you're turning a C plus into a B, I would not think that you're going to keep that cap rate. Number two, people take a trailing cap rate. What they forget is that if you're going to increase your price from the last price, you're going to have more taxes for the next guy, substantially more. Your basis is going to increase. That is going to jack up that cap rate on trailing. You really need to look for the future, see what the next person's going to have. The last thing I'll touch upon is price per door. There is a limit, regardless of the cap rate, of which you can charge. And I think that it's instructive for sponsors, for crowdfunding people, for people new to real estate, to say, what are you going to sell this at on a price per door in 2 years? So, well, the cap rate. I would avoid that. And I think it's a lot better to say, what is the highest trade in that area? If you believe that if you sell something at a 6.5, 6 cap, and that's going to trade for $150,000 an apartment, but others that are nicer than yours have only traded for 140, there is both a psychological barrier as well as a replacement cost barrier. You need to make sure that you are not over replacement cost. So those are the pitfalls that I would look for.
That's a really interesting point, and we call that a sanity check, where we're focusing on the exit cap rate. Is it a 5 3/4? Is it a 6 or 6 1/4? And then we just have to look at the price per door, and then and does that make sense for the market based on sales comps, as you said? And one interesting point I'll add as well is we looked at a deal that had very large units, average floor plan 1,400 square feet, and what that means is each individual unit can command a higher rent, obviously, and that translates to a higher price per door. So again, that psychological barrier comes in. Hey, on a cap rate basis, this probably makes sense, but can you really wrap your head around paying 150 a door for a C asset, for example? So it's an interesting, your valuation actually gets weighed down by certain factors.
I think you're right, and I think that's where expertise comes into play. For example, we're about to buy for our third fund an asset, and we're under contract, so I'm not going to disclose it, but it looked like it wasn't a steal. It looked like it was a good deal, not unbelievable on a price per door basis. But these were townhomes and very large units. Now, is that going to make the biggest difference in the world? Absolutely not. But when you have 1,500, 15.5 on a 3-bedroom in a tough area in a townhome style that's secure, that will command an extra $100, $150 a month. And that's extraordinarily meaningful when you're looking at these assets. So I think that it can work one way or it can work another. And that's where you really need to know how you're doing, what you're doing, especially on the equity side. You need to be able to understand that whatever's on that piece of paper is not necessarily true. With regards to sanity checks, we saw a deal from somebody in a market we're looking at, and they wanted to cut the operating expenses, $60,000. Now, if you're looking at that on CrowdStreet, or you're not an effective allocator, or trying to do it yourself, or in a syndication, you just assume that's true. But nobody asks, well, who's going to collect the rent? Do you have a super? Let's just call him a super. Forget maintenance supervisor. Let's just say, do you have a super there? Who's got the big set of keys hanging on their door? Who's going to clean up the pool when it's done? And when you start whittling these things down to a common sense area, you find that you do need to actually know what you're doing. And as equity, you need to be able to step in if, gosh forbid, something were to happen to that key man on the sponsor. You need to be able to step in on day one, have access to all the bank accounts, having your biweekly calls with the people on the ground. They know you by name, know you by face. They are reporting to you not just as equity, but as a real partner in the deal.
Good stuff. So congrats on the deal under contract. And with that in mind, I want to shift the conversation to your sourcing efforts. So tell me more about how many deals you guys bring into the shop. How do you look at them? What's that sourcing process look like, the deal funnel?
Well, I would say that this is a very typical course, but we're very fortunate that about 30 to 40 deals cross our desk every week. So we have reached this point in our fund life and our company life that we're seeing a lot. And one of the expertise you have is to be able to identify what's real and what's not. And for every 40 you see, let's just say 36 are not even worth looking at. You just know right away, they don't make any sense, and you can pass them. So as you become more established, deals come to you. Other sources are, we pick up our phone. We take a lot of incoming calls. We were introduced by one of these guys that's trying to put deals together, and we find that it's very effective to pick up the phone. If you're seasoned, you'll know who's real in 10 minutes and who's going to actually put you in front of somebody that is legitimate. That's one way. Another way is we have our sights set on Las Vegas. right now. We think that in the long term, it'll be a good place. We've spoken about this. And we had our analyst go and have Vegas week. Said, I want to know every single small operator in Vegas, and I want to set up calls. And if you have good people working for you, they'll do that. The lucky thing about this business is the more you have under your track record, you're real, you have good recommendations from your other operators, people are going to take your calls. So being an effective allocator fund, you have to chase these markets. You have to have a thesis and you have to execute on this thesis. You're better able to execute if you have track record. It's one of those things that the bigger you get, to a degree, the stronger you get. When it comes to buying it with one of these sponsors, they look you up, or they've heard about you, or they can call a lot of people and they say, well, Auerbach Fund 3 is our equity on this deal. You're going to get the deal. We're going to get what we want. One of the difficult things in real estate, as opposed to working at a hedge fund, is if a hedge fund likes a stock, they can simply buy it. They can make their investment strategy happen immediately with no barriers. In the real estate business, you can't simply make your investment strategy happen. Simply to begin said strategy on a specific asset is difficult. Extraordinarily, you've bought deals. It is very hard. There's a lot of moving pieces and a lot of disciplines you need, from legal to construction to finance. There's a variety, and personalities. It's a personality-driven business, both on the tenant side, the sponsorship side, the equity side, and even on the property management side, and clearly the contracting side. So
absolutely. Yeah, no, that's all good stuff, good points. And I think you kind of took a step back to that broader picture of comparing it, the private markets to a hedge fund. And I think it's very true that as you get bigger in the public markets, life gets harder, right? I have a friend who's running a hedge fund, and he has different strategies, and the capacity of the strategy is great, or the returns on the strategy is great, but the capacity is only $100,000. I can only, invest $100,000 into the strategy. For private investments like real estate, the bigger you get, the easier the returns get, and easier it is to do business, as you said, because of the relationships and access.
Well, it's interesting. I think that the more experience you have, the easier it gets. In some cases, bigger is worse. For instance, we've said that we would, in this particular strategy, we wouldn't go over 150, even if people were banging down our doors on Fund 3. We think that the smaller deals have more opportunities. So if you have 500 million under management, you are buying deals with a lot of smart people looking at it. And when a lot of smart people are looking at it, they become efficient. When you're looking at the smaller deals, they're more inefficient. And it's not because the people are necessarily not as smart, but they're less proliferated with real estate professionals. You're dealing with people that need an exit. You have stories of divorces where people simply don't want to be in the property anymore. And they've made money, everybody wins. They're just not in a position to value add it. There's no new capital. Where you won't see opportunities is on some of the bigger shops. For instance, if you're looking in Vegas right now, what you're going to be doing is looking for deals of people that want out or sick of it on the smaller side, that don't have strength with their bank. They're going to sell. Somebody that's strong, or somebody that has a guy like me as their equity partner, they're not selling. Even if in a crisis, they're not going to give that asset up because they have the strength to hold it. So you're not going to find steals if your minimum equity check is $20 million. I should say you're less likely to steal something.
Yeah, I agree with that. You brought up the point about not selling and having the, not needing to sell because of the cash flow that was inherent in the underwriting. So talk more about the typical hold period for you guys, and what helps you make your decision as far as selling or holding.
Well, the best way to frame it is we want to have effectuated our business plan in 2 to 3 years. So remember, we're not people that just say, I'm going to buy it at this and flip it at this. Clearly that's in your projections. But a business plan needs to be effectuated for us immediately. It needs to start on day one. We make it very clear with the sponsor that we are not going to get our arms around this for 3 months after we buy it, unless you absolutely get a bargain basement price where you can't lose because it's just so cheap and it was just really fast, which is rare. We want a plan going in. So you want to be stabilized in terms of all of your units renovated or all of your retail spaces leased up within 2 years. From there, there could be a little more creep. And that's your decision that you are cash flowing. At that point, you see where the markets are and if it's a viable time to sell. On an IRR basis, the sooner you sell, the better. But that's not necessarily so strong. Our investors, if I told an investor I'd get them a 20 IRR in 2 years, or I could get them a 15 in 5 years, their absolute return is a lot stronger. 15% compounding is a very powerful thing if it's for a long duration. So we try to look at effectuation of a business plan quickly, as opposed to I'm going to hold it for this, because you can't control that. Think of everybody that was trying to thread the needle and was selling things this year. Didn't work out so well. We had planned to sell a bunch of our stuff that had already been stabilized in the first 6 months of this year. Clearly, we didn't sell it. But we were cash flowing because our business plan was not reliant on a sale. And that is a critical part of investing, is to base your decisions on whatever you can control. The more you can control, the stronger it is. Development deals, where we do not do development deals. We have one development deal out of 23, and there's an angle to it, et cetera, and a lot going on there. But it has to be an exceptional case because a development deal, you are threading the needle. By the time you've actually put your suspenders on, the guy that was value adding, that individual has already gotten a lot of cash flow. We find it the riskiest part of the spectrum, and not necessarily the highest return either. There's this chart that says core is the lowest risk, lowest return, development's the highest risk, highest return. I think that that is a bogus chart. I think that opportunistic is the lowest risk, highest return. If you buy $1 for 50 cents, would you consider that a high risk investment? It's a low risk investment. If I said I'm going to build $1 for 95 cents and hope that the euro doesn't overtake the dollar, that's a pretty high risk investment. So we find that development is not our favorite asset class. We believe that value add and opportunistic have the highest returns, the lowest risk, then core plus. Core, remember, you're playing defense right from the get-go on core. You are playing defense from day one. And then you have slightly better returns than core plus for development, clearly, but your risk is astronomical. You're betting that there's such a demand for new product on the sale that you're going to get a big sale. You're selling to the buyer that likes shiny and new. And there's buyers out there for that. But I think that those buyers will become a little less as time goes on and they have access to more value add type situations.
Yeah, definitely interesting points. I think not necessarily the counter argument, but the addition to the development idea is when it's all said and done, now you've developed a core Class A asset, which is less risky than, a Class C asset. So if a developer theoretically would be willing to build to core and hold for the next 10 years, then you could start to understand, okay, well, they're less reliant on the exit and they're willing to ride out on the, little cash flow that is available. But in generally speaking, developers are in it to build it and sell it. So that's where the trouble comes in.
And even if you were, why would you ever want to go through the pain of building to be core unless you're going to sell it? You want to stabilize, you want to build to a 6 cap. And we're buying at 6 caps, guys like you and me, and trying to turn them into 9 caps. And that's 6 caps day one. I just never understood that. There's reasons why. I mean, we could both put pen to paper and discuss the fees that are involved in that. There's also other reasons on a large scale. If you're a sovereign wealth fund and have $500 million to place in a single deal, you probably will get better returns developing because your options are limited. But on the smaller plays, I don't see it unless there's obviously specific cases. If you're building Wawas or 7-Elevens, building McDonald's, build the suit, you build it to a 7 cap, sell it for a 4, there's spread there, and you can take your risk that interest rates aren't going to go up 300 basis points in the 15 months that you're going to build it. But there's a lot of inherent risk.
I want to touch on financing. So you mentioned opportunistic in your view is the best risk-adjusted return. I think a very important and tricky part of the opportunistic equation is how it's financed, right? Because you have less options. You have to go to the bridge market. Depending on how distressed it is, you may even have fewer options than that. So talk about how you guys typically go about financing your deals.
So we don't do recourse. Sometimes the sponsor is willing to take the recourse. Fantastic. If they're willing to do it, you're getting very low rates. You're not going to get the same rates on a bridge that you would on a stabilized Fannie Freddie. So how do we look at that? We never financed to a point that we couldn't cover the debt service, assuming the work was done. So we never get over our skis there. That's number one. Number two, we, being the equity, typically enhance that financing through our strength. That we don't do a deal without internally thinking we might have to put in a few more dollars to make sure this works. What we find is that people are undercapitalized and they can't finish the job. Things about bridge financing that a lot of people don't take into account. A lot of times you float the bill and get reimbursed on your construction. That's one. Number two, if you have 50 investors and you have to make a capital call because you're a couple $100,000 over, typically lenders don't like that. Your thesis has to be intact to make sure that the bridge financing is not too aggressive. The stronger your sponsorship equity team is, the more you're going to avoid these hard money 9% loans that are absurd. In terms of the bridge and the rates, the way we look at it is if you do your business plan effectively, you will be out of your bridge loan in 2 years. So you contribute the incremental difference that that loan would cost you. Let's say that it's 200 basis points higher than conventional financing. Well, now you have 4% on the debt, and let's say you financed it 70%, 60, use easy math, 60%. That really is 2.4 in total on your entire equity stack over 2 years. So you're talking about very little on your entire equity stack. It'll lower your returns by 1.2% on an unlevered basis. And a lever, it'll affect you, but you wouldn't be able to effectuate the deal otherwise. What's good about the bridge financing is the flexibility. It is very difficult to collect rent right now if you're in a stabilized government conduit loan, because that's really the financing that you're using. Unless you're going CMBS, which is likely not going to do on multifamily, especially in our world. You have a lot of covenants and restrictions and no flexibility. So we like bridge. And we have lenders that have been very strong, that we have very long relationships with, that provide a flexibility where you could just make a phone call and say, this is what we need to do. We have found that we think that replacing the cabinets will be better on these units, painting them will be better on these. If you have a rigid agency, you are locked into this unit as this XYZ. With bridge financing, so long as you're not going over budget, you're just moving around costs, as long as it makes sense, they're not going to say no. They're in it as a partner rather than to just check a box. And that's been beneficial for us.
Would you say most of your bridge exits are via a refi or a sale?
Mixed bag, 25% refi, 80% sale.
So I think one of the interesting calculations is, right, you stabilized and now you can get out of the bridge loan and now have a cheaper rate via a refi into a conventional loan, or you could sell, right? And so the question is, a sale is going to take longer. So if you refi today and then start saving on the interest, and then maybe look to sell in 6 months or a year, assuming you have that flexibility, right? It gets to this difficult, calculus essentially. What is your take on that?
It depends on the term. So there's several options available. And let's just talk about the agency stuff for now, because that's in vogue. If you can get a 3-year refi, you're going to pay a little more in rate, but it'll give you flexibility. So that's number one. That's not a bad idea. You can take some money off the table if you think that there's some organic growth left, or if you see that your area is being brought up by everybody around. And we're not talking about gentrification. We're not talking about taking $800 rents and turning them into $3,000. We're talking about everybody putting in playgrounds and taking $800 rents and turning them into $900 with tenants hugging you and happy. It's everybody wins. We're not talking about knocking people out of their neighborhood who don't look a certain way because they can't afford it. This is a marginal growth. And you see that crime is going down. A lot of these landlords have done the right thing. You might want to see what happens because you're collecting cash flow, you've effectuated your business plan, and you've refied out. So that's a decent option. When you get into the 5 or 10 year, you have risk. If you were to finance 2 years ago on a refi at 4% or 4.1%, which was unheard of, believe it or not, that's not good debt anymore. So you do take interest rate risk because your exit is so severe. If you take out a 10-year loan, you have a 5% prepayment penalty. You could have full yield maintenance. You can't leave. And the next person is not going to want to assume your debt for 2 reasons. If the property is worth more, you'll be under-levered. And number 2 is the rate's too high. So now you have a choice of sell it with the debt, which will sell at a discount because your debt is no longer good, or you can pay off the loan, which is going to be extraordinarily expensive. If the loan makes up 70% of your capital stack and you have to pay 5%, that's going to be a meaningful chunk of your equity.
Yeah, that's a tough one. So let's end on this last point, which is timeline for your fund getting involved in the deal, and then walk us through getting involved, LOI, term sheet to closing. What does all that process look like?
It's case by case. Let's look at it 2 ways. New sponsor, existing sponsor. New sponsor, we typically like the deal to be under contract. We want it buttoned up. A good indicator right off the bat is actually their Excel model, as mundane as it would seem, because that is the template for organization, attention to detail, and clarity of thought. If everything has been thought of in that model, we feel more confident that the sponsor is thinking about everything. If you have very round numbers that aren't backed up by anything, it's going to raise our hackles a little bit. So that's number 1. Number 2 is we want to know that they have the ability to go find the debt, get the property under contract, and now we are auditing their process. What we find is that with somebody we don't know that's not strong, we're not going to go chase a deal with them. It's just not going to happen. So with a new sponsor, we like to get in after it's under contract, or at least there's a compelling case in the LOI period where we can indicate a level of interest, but not commit until it's under contract, we've visited, we've scrubbed the numbers, and we have all the due diligence materials. The other case is with an existing sponsor. There's sponsors we've done 4 deals with. We're very comfortable with that sponsor. We are friendly with them. Some of these people are my closest friends now. And we know the way they think. We know they're competent. And by us being involved early, we get a much better price. I could get on the phone with the seller and use the strength of our company and our track record to drive that lower price. We had a lot of success with that in the past. And the ability to throw down big deposits, soft deposits even, not even hard deposits, but people underestimate the power of saying on a deal that would require, 200 soft deposit that you could just put down 500 during no risk. We don't put deals hard unless we know that we have the financing lined up, everything's ready to go. So having that strength gives an indication these are real people. the due diligence period is not a find the equity period. It's a real due diligence period. We're making sure that what the seller represented was true. That's really our timeline, but we are involved through the entire process. Our lawyers also look, we use Holland & Knight, Janice Schiff, I'll give her a plug, has we say that we don't do anything without Janice blessing it. And they are shadowing, if not taking over, all legal negotiations, look at all the leases, etc. So we are not dumb, passive money. And most funds, this isn't unique to us, most real funds are not the case. But we do find that our experience has been that people, the proof is in the pudding, they come back to us, enjoy the way that we partner with them. While there might be a little kicking and screaming, at the end, it's like, wow, these guys were right. Good thing we looked at it this way.
So on the soft deposits and even hard deposits, what is the structure of that? Will you contribute 50-50, you and the sponsor, or is it based on proposed capital account, 90-10, for example?
Depends on the deal. What we've done 50-50 and we've done proposed capital account. Sometimes we will replace the sponsor's capital once we've signed and the agreement has been transferred over to our joint entity. Then the entity is theoretically putting up the deposit. Other times the sponsor is putting in, let's say, $500,000 into a deal. 300 is already in there as a deposit. That sponsor would credit it towards our capital account. It would go that way. It's a case-by-case basis. Depends on our conviction of the deal. Typically, this is not an issue. Our sponsors typically have the strength. But listen, we do what we say we're going to do. Again, not unique to us. That if we're going to do a deal and we're going to be partners, put up our share of the at-risk cost. I think you find these things go down to 50-50 on the pursuit costs is when people don't believe the deal can get done. That's when you're reaching for that debt and you're worried you're not going to close or you don't have enough equity to close all cash. That's when these things come an issue. These are, the more confidence you have that you're going to close a deal, the less these are an issue and more a semantic. We don't do deals that we're not going to close. We've never lost a deposit and we don't plan, and we've never left anybody at the altar.
That's huge. Well, Peter, really appreciate your time. Why don't you let people know the best way to find out more about Auerbach Funds and get in touch?
Sure. You can go to auerbachfunds.com or contact IR at Auerbach Funds, AUERBACH funds, one word, .com. We just finished our friends and family round, so we don't have anything open for anybody, but you're welcome to call us, contact us. A little busy right now, but we always try to help anybody we can. We love to give advice, and we love to educate people on how not to get in trouble. It is, if I can leave you with one last thing, real estate, you see a lot of these rich real estate guys. Real estate is not the tech business. This is a tough, I call it a lunch pail business where you are grinding it out. For every person that's 5 times their money, there's 99 people that tried to do that and failed. Real estate is supposed to be your asset. That is your safe house. That you're supposed to be getting those distributions in the middle of COVID. You're not supposed to be going belly up. Do not look for the shiny deals. Most of the time, they're not true. And if you're an individual investor, there's very little chance that guys like Rob and I passed on these deals and they came to you. It's just unlikely. So be careful, be safe, and thanks for having me, Rob.
Thanks for coming on.
See ya.